Hi everyone, welcome to Nerd It Off. In today's video, we are going to learn about FP&A SaaS KPIs, that is ARR and MRR. In these two KPIs, we are going to learn about what it is, why it matters, and the three top common mistakes which one can make. So let's get started. What is MRR? MRR is monthly recurring revenue. That is, it is the revenue that your business makes every single month from the subscription fees. For example, you go to a gym, and in that gym, you pay a subscription fees of $200 per month. So that $200 is nothing but the MRR of that gym. So let's suppose in that gym we have 100 members and every member is paying $200. So the total MRR for that gym would be $20,000. So, in simple terms, MRR is nothing but the recurring revenue that your business is getting every month. So, that is MRR. So, the formula for MRR is active customers into average monthly fee. There is one thing to note here is it does not include one time fees. One time fees here could be, for example, you have to buy a yoga mat from the gym. You have to take a sipper bottle. So those are the one time fees or the one time value that a customer is putting into the business. So for that, that is not your MRR. That won't be included in your calculation because that revenue won't be earned by you from the customers each and every month. It is just for one time. Moving on to our next KPI, which is ARR. ARR is annual recurring revenue, which is calculated as MRR into 12. ARR tells us how much recurring subscription revenue a business expects to generate in 1 year from its active customers. You can think of ARR as annual view of your recurring revenue. If your business generates $10,000 as MRR every month from their subscription fees, then ARR is equal to MRR into 12 months. Therefore, our ARR comes as $1,20,000. ARR is simply MRR converted into annual number. Instead of looking at revenue month by month, ARR provides a yearly perspective. It removes short term monthly fluctuations and helps management focus on long term growth of the business. For example, if a customer pays every month, ARR answers the question: how much recurring revenue will this customer generate in a full year? This makes it much easier to compare business performance over time. Who uses ARR? ARR is used by most of the SaaS companies to understand forecasting, do strategic planning, evaluate company growth, and it is also used in business reviews. ARR versus MRR. Both metric measure recurring revenue, but they serve different purposes. Let's suppose if we have to track monthly billing, we will use MRR. Why? If a customer pays every month, management wants to know how much recurring revenue was generated this month, how much did MRR increase or decrease compared to last month. Therefore, MRR is the primary operational metric. In case if we have to analyze annual contract, we will track ARR. Why? If customer signs annual contracts, monthly revenue does not tell the complete story. Instead, ARR shows the annual value of active contracts, making it easier to understand the company's recurring revenue here. So, most SaaS companies report both. MRR helps monitor short term monthly performance, and ARR helps measure long term recurring growth and is preferred by investors. Moving on to our next slide, why ARR and MRR matter. There are 5 reasons that every SaaS company tries to calculate and get the best out of these KPIs. First of all, is predictability. Everybody wants to know how their company is going to perform next month so that they can plan their hiring, spending, and growth. Business health check. If ARR is growing, the company is doing great. If the ARR is shrinking, the company has a huge problem with the customer churn. So they need to focus more on getting new customers or retaining the current ones. Investor language. Every SaaS investor wants to know what is your MRR and ARR. That you might have heard about these terms in the Shark Tank. It is a universal benchmark to compare different companies. Valuation basis. If a SaaS company has to value itself in the market, it will try to analyze its ARR and then get the predictability of what their value can be in the coming 8 years. So that will help them with the valuation of their company. So if company has higher ARR, they will have higher valuation and they will be able to quote higher value for their company in the market. Forecasting. If you know your ARR, you can easily get to know what could be your next year's growth rate by simply calculating the growth rate percentage and adding into it. It helps to project future revenue with reasonable accuracy for the board planning. Next, we have here is MRR waterfall, which tells us how MRR changes every month. So, for example, you know the MRR for the month of February and you have to calculate the MRR for the month of March. That is how you will calculate it with the help of this formula. So, the formula here is ending MRR plus starting MRR plus new MRR plus expansion MRR plus churned MRR minus contraction MRR. So, we will understand each of these components in detail. So, starting MRR would be the MRR that you had towards the end of February. New MRR is if the new customers signed up for your services. So, for example, there were 100 customers who signed up for your services. So, the revenue that we will be getting from those 100 customers is nothing but your new MRR. Expansion MRR. Expansion MRR is if your existing customer upgraded. So, for example, if there were 20 customers who used to be on the basic plan and now they upgraded to the premium plan, so that extra revenue that you're getting would come into the expansion MRR. Next, we have churned MRR. Churned MRR is customer who exited your company. So, for example, there were 15 customers who stopped using your services completely. So, those revenue loss from those customers would come into the churned MRR. Next, we have is contraction MRR. Contraction MRR is just the opposite of expansion MRR. In expansion MRR, existing customers are upgrading. Just like that, in contraction MRR, existing customers are downgrading. So, for example, if you had 25 customers on premium plan and now they are shifting to the basic plan, so the revenue loss from that will be counted in your contraction MRR. So, this is how we will be getting our MRR calculation for the next month. Now, let's discuss about the limitation of ARR and MRR. First limitation is it does not show profitability. Let's suppose a company has $100 million of ARR, but here we are only able to understand its revenue but not its cost. It could be burning cash of $20 million a year. It could be having huge costs in the business. So that is something we are not aware about. Next, we have it does not show cash flow. So, for example, if we got an annual contract of 1 million, we will calculate it as our ARR for that year. But in reality, we have not got 1 million in our bank just today. It does not show customer quality. Why? Let's suppose there is a business A with 100 customers and each is paying 1k dollar per year. On other side, there is a company B who has only one customer which is paying 100k dollars every year. So in that scenario, company A is much better because it has multiple customers and even if one or two customer leaves, the revenue won't be impacted that much. But on the other hand, in case of company B, if that one single customer who has a huge contribution in company's revenue leaves, the company's entire revenue cycle would be impacted. ARR and MRR can be gamed easily. Why? Some of the companies can mistakenly take into consideration one time fees at the entire contract value, like we discussed just now. So, all of these things inflate our ARR value without reflecting the real health of the business. Now let's understand how MRR is calculated with the help of an Excel example. Here we have the customer subscription list for 10 customers where we have also mentioned the plan that they have with them. So, for example, Acme Corporation has enterprise plan, Beta Startup has growth plan, Charlie Limited has starter plan, and so on. With each plan, there is a monthly fee involved. For example, for enterprise plan, we are charging them 5,000 per month. For growth plan, we are charging 1,200 per month. For starter plan, we are charging 299, and so on. So basically, what we have to do here, if the status is active, there will be a MRR contribution in that particular month. But if the status is churned, that means the subscriber has left the firm and is no more related or is no more purchasing our services. In that case, we have to put a zero here. So for that, we will just simply use an Excel formula. If this is equal to active, then put this value. Otherwise, put it blank or zero. So we just simply drag this formula down. So see, since here it was churned, it is not taking 299 as the price here. It is taking 0 because of this if logic condition. Now, next step is to calculate total MRR. So total MRR is nothing but the sum of above values, which is 20,398. Now we have to calculate ARR. So the formula for ARR is MRR into 12. So now we have our ARR as well. Let's look at another example where we are showing how we are calculating MRR waterfall. Here we are showing month by month movement of the MRR. So in the first example, that is starting January, our starting MRR was 20,000. Our new MRR, that is new customers, the business that we got with for revenue 3,500. Expansion MRR was 800. Churn MRR was 1,200 and contraction MRR was 300. With this calculation, we got our ending MRR as this 22,800. This 22,800 became starting MRR for February. Similarly, we have new MRR for Feb as 4,200, expansion MRR as 1,200, churned MRR as 800, contraction MRR as 200, and so on. Similarly, like this, we are able to calculate the ending MRR for months January, February, March, April, May, and June. Now, very easily and simply, we can calculate our ARR, which is MRR into 12. We'll simply drag this formula towards the end to get the result. Now, MOM growth. MOM growth, that is month over month growth. This can be simply calculated by subtracting our current month growth with the previous month's MRR divided by previous month's value. So the growth for February month is 19.3%, and for March it's 5.5%, April 18.5%, May 10.7%, June 11.3%. So this is a simple example which is showing how we generally make a table for MRR waterfall. Now let's look at the top 3 common mistakes that a person makes while calculating ARR and MRR. First one is multi-year deal inflating ARR. Let's understand this with the help of an example. There is a company named Global Corpex. It signs a 3-year contract for a total of 90,000. Now, what mistake that one could make here is consider the entire 90,000 amount in the current year itself. But one thing to notice here is this amount, this contract is for 3 years. So, the right approach here would be to only consider 30,000, that is 90,000 divided by 3, 30,000 in the current year, and rest 60,000 should be considered in upcoming 2 years. So, why we are doing this? Because that is the actual portion of the ARR that we are having for the current year. Moving next, we have including one-time fees in ARR. So, generally, what happens whenever we are using a service, we need certain help with setup, professional services. So, what companies do, they consider that also as their ARR or MRR. The problem here is setup fees like of 10,000 amount is paid once and never again. So, once the customer has got their service set up in their system or whatsoever, they won't be asking for that particular service. That setup fee won't be there. So we should only consider monthly subscription, which is 1000 per month. And therefore, the correct ARR would be 1000 into 12, which is 12,000. Here, one thing to notice is the name itself. The full form for ARR is annual recurring revenue. The word recurring itself means that we will only be considering revenue which is recurring, which will happen again and again, which will be repeating itself. So, any revenue type like setup or onboarding fees, implementation services won't be counted as ARR. But things such as monthly subscription, which we are going to get every month, which is recurring every month, will be considered as ARR. Moving to the next one is booking is not equal to ARR until contract is live. So here what happens? Most of the companies consider their ARR as soon as the contract is signed. But one flaw here is signed is not equal to started. We can only consider ARR when when the customer has gone live. Before that, it is not right to consider that ARR as a revenue. Why? Because we should only consider revenue when we have provided the services to the customer. So let's suppose in a general contract, how the steps happen. A contract is signed, legal review happens for the contract, onboarding kickoff is there, and then we have the go live of day one. That is where the ARR starts. So for example, we are sitting right now on Jan 15. Acme Corporation had the average contract value of 24,000. They are going live on January 15 itself. So since go live is equal to sign date, we will immediately count it this 24,000 into our ARR. But on the other hand, for a startup XYZ, their average contract value is 12,000, but they're going live on April 1. There is a gap of 3 months. So they're just booking today, they're not going live. So we will not consider this amount as our revenue, as our ARR immediately. We will wait till April 1st to consider it as our revenue. Similarly, in this example, they are going live on 15th March. So we will not consider this as a revenue. We will only take into consideration when March 15 happens. Now you can look at these key takeaways from the video for a quick summary. Next up in the series is churn, NRR, CAC and LTV, rule of 40, payback period, burn multiple. Stay tuned for more videos on Nerd It Off. Thank you.